excited about this particular investment. We've actually had this going for a few months now. We've had a lot of interest in it, and I'm going to just share kind of why I really like this investment. We're going to get into the reasons why, but primarily, a lot of times we have deals that we know are high risk and high return, and we have deals that we maybe know are super, super safe, or things like treasuries or things that are very, very safe. But a lot of these deals that were kind of in between, right? These deals that were like, hey, we think there's a mild or moderate amount of risk, especially in some of the multifamily or the bridge debt deals or other things we've seen. There's been some risk there that we didn't realize. And so this deal is one of the safest deals. I mean, obviously, no investment deal is 100% secure, but very, very safe. And I'm going to get in why I like it. And the returns, especially for the 3-year term, are really, really impressive. So keep the chat going there. You can put in where you're coming from. Really glad you're here. We've got a bunch of folks. We'll have a few more join us. And again, I'm very excited for this investment. So I'm going to introduce Patrick Grimes, is a good friend of mine, and we've been friends for about 5 years. And he is partnered with Lance as well in this on the lending side to help. There he is right there. Another bald-headed, good-looking guy there. And actually, a little truth be told, we are both super excited about this event and about this investment. We are both feeling sick. So I've got a cough. Patrick actually has COVID, but if he sneezes too hard, where you won't catch it through the computer. At least we haven't figured that out yet. But Patrick, good to see you, brother. How you doing, man?
Yeah, hopefully it doesn't morph so much that it turns into a computer virus. There you go.
Exactly.
Yeah.
Awesome. Well, we're gonna have a good time, guys. We're just gonna jump right into it. We are gonna take pauses for questions. If you have questions, feel free to drop them in there. Again, you will get the replay afterwards. Again, this is for accredited investors. But Patrick, why don't you go ahead and start, and you can do an introduction of yourself, and we're gonna go ahead and have a good time here.
Well, yeah, I appreciate that introduction. A lot of great things that you said there. Also, there's preferred equity funds, I would say also, which have been a little bit thought to be very safe, and as it turns out, ended up not being so much so. And we're going to talk a little bit about why that is, and why sometimes individuals seek a little bit safer, a little lower risk and higher returns in times of market cycles that are reducing. And while we're not necessarily in a recession in the overall economy, or some argue we are, some argue we aren't, you will see in commercial real estate and residential real estate that nationally we are. Much more so in commercial real estate. In fact, in commercial real estate, it's a better time right now, both on the debt and equity side, than it even was in 2009 and 10 to buy or to lend. And so this is about lending. It's about being a real estate investor, but being a real estate investor into the debt, the first position, instead of the owner, the equity position. And so I had to do that in a low risk way. And I'm really excited to be able to present this to you. We've launched this, and it's just way exceeded our projections, way exceeded our expectations. Please keep it dynamic. Throw any questions you have in the chat. I think Bron's going to help out with moderating those as we get into this. But yep, it is for accredited investors only. We're not financial planners, or I am not. Bronson used to be. He's a recovering financial planner.
I'm still recovering.
CPA. I'm not a CPA or an attorney, so this is not investment advice, accounting, or tax advice. Go ahead and please seek your advice from your team before making a decision. This is also not an offer. The offering will be in the private placement memorandum, operating agreement, subscription agreement. Now we got all that out of the way. Here it is, Bronson. I'll talk a little bit more about myself in a second, and then Lance. And we're meant to be the presenters. Believe it or not, my COVID allowed me to still come on, while Lance is in Houston after all those storms and they lost power. So he's not here.
So COVID is not the worst thing anymore. Okay, so we haven't met, I think most of the people on this call we've met, or at least you're familiar with me. 200 million in multifamily real estate, host the Mailbox Money Show, the author of this book here. I just recently decided, it's actually behind me on the shelf, decided to write another book called Rich Brain: How the Wealthy Change Their Brains to Change Their Bank Accounts. So that's, be more on that later, but writing a new book on that. Raised over 40 million for real estate, ATM machine, private equity, other types of things as well. You can scroll down, Patrick, there. And my former job was a medical device sale, 9 to 5, and did some single family stuff. This is, I guess, maybe this is the earlier part, but how I kind of scaled up, started working in a multifamily, and then founded Bronson Equity about 4 years ago. And it's been awesome. So, and Patrick, why don't you share your story here real quick?
So I started out machine design, automation, and robotics. Like a lot of you, I was a high paid professional. out there doing the rat race, working hard, trying to get out. I got into real estate early in 2008, lost everything in 2009 to 10 in the subprime mortgage collapse. I was fully indexed in pre-development, head over my skis in debt. Crawled out of that, still successful engineer, moonlighting real estate, but recession resilient markets and single family. Scaled from single to large apartment buildings alongside of Bronson. We've known each other for quite some time, rubbing shoulders in the multifamily apartment building space. Scaled to about 600 million, 4,000 units, southeastern states and Texas. I have a book not as cool as Bronson's, though. I partnered in mine. I write for Forbes, so I've got dozens of articles in Forbes, right on stages. Diversified into energy as well, and we'll talk about why that's important. And then we decided we needed to start a company that offered more options into investments. And so we'll talk a little bit about why that's important. Lance, who's not able to be here right now, is the other partner who brings a huge background in not only technology, but also in debt. He co-founded Verivest and Fairway America, raised it from $0 under management to $3 billion under management. Verivest is a large fund administration company, primarily administering debt funds. And this has been going on for decades. He also, on the private equity side, had $3 million in equity and $1 billion in real estate at Fairway America. Again, co-founded that and raised that from $0 to $300 million. So he is now the chief investment officer of the Recessionary Income Fund. That is this investment offering we're talking about here today. He's also running PIM Rapid Lending, Passive Investing Mastery Rapid Lending, which is the loan origination company that then goes out. We have webinars like this where we go out to investors to raise capital. And then the lending company has business where it goes out to, or it's requested by owners to lend. And so we raise capital and we lend it. And it's a diversified loan portfolio we're investing into.
And one thing that's kind of unique about this, guys, is that it's really unique to be in a debt fund that's first position. So you're not talking second or mezz or whatever, but also to be with a lender because they can share some of those fees. And so that's where you'll see some of the returns here, and they look like equity returns, but they're debt returns. So they're much safer, we've really found. But anyway, it's just a very unique thing that, and actually if you're over, I think if you invest over 250, it's like 60% of all the fees from the lender go to the investor, which is kind of wild. So it's a really kind of a neat setup.
One of the interesting parts about this too is when you think about low risk, you think about lower return. And it just so happens to be that at this time, you're able to get a higher return with high interest rates and banks pulling back in debt at a lower risk. So we'll talk about that in a minute. Combined experience. So between all of us with private lending, debt funds, retail, energy, self-storage, multifamily, industrial warehouse, triple net. In terms of debt, we've got 57 million in loan originations, 500 million on a 500,000 average loan amount. So we call that small balance commercial real estate. That's really the sweet spots where we fit as a fund. And it's really that underserved sweet spot where we can get across a lot of different loans. And then in equity, as you can see, there's substantial equity ownership. And it's important to have that balance because, in the worst case, maybe you own a property in a debt fund. And so we don't lend on anything we wouldn't want to own. Not that hasn't happened. And if it does, there's significant upside for us. So let's talk about why alternative investments, because it's really important to understand, first, why invest out of the stock market. If you're in the middle income, you can see that at 8% of their wealth, that's that green bar, 8% of their wealth. Can you see my mouse there, Bronson?
Yeah, I can see it. Yeah.
Is in what we call alternative investments, right? And 25% of the upper income. Now that's $500,000 to 10 million in alternative investments. As you get into more wealthy individuals, 10 million plus is about 50% of their wealth outside of what are traditional securities, mutual funds, trusts, typically what you would put into your IRA account or 401k account, right? And so we always want to look towards that next step. Like if you're making under 500,000 a year, you want to look towards what those individuals are doing and make steps in those directions. So how do you do that? If we look at the Tiger 21 allocation, this is an organization that does have 10 million. They just increased it from 10 million in net worth to 20 million in net worth. They do publish their allocations. And it does corroborate here. So it's showing alternative investments over 50%. It's 27% in real estate, 26% in private equity. It's important because you can't be over-indexed in real estate or you can't be under-indexed. And some people have everything in traditional investments in the stock market. Some people come to me and they're like, I've gone all in real estate. And that's not a balanced allocation. Also, fixed income, 7% in fixed income. How can you do that, right? I think Bronson talks about cash and cash equivalents when he talks about gold investing sometimes. So there's ways to allocate even the left side out of traditional investments into alternatives in a safe way. Fixed income is one of those. And we're going to talk a little bit about how to meet both this real estate allocation and this fixed income in a diversified debt fund here today.
And this, I want to say, Tiger 21, you have to be worth over 10 million to be a part of it. I think it might be 20 million now. But it's interesting how people invest. And not everybody has 7% in fixed income. Some people might have 30% in fixed income, or they have a higher amount and some people have less. But it's interesting to see how wealthy people allocate themselves, right? They're not, a lot of people that are kind of, $1 million to 5 million, it might be a lot in bonds and stocks and different things like that. So you have like private equity, public equity, these kind of things, but then you get real estate and like Patrick was saying, the fixed income. It's just really good to have things that are stable, that are providing monthly or quarterly cash flow. And I talk about that a lot in my book about cash flow really being better than just great long-term appreciation someday.
100% agree on that. So that tees us up to what is the Recessionary Income Fund? Really, it's an asset-backed debt fund. It's a diversified pool of loans that you're investing into. One investment is split up essentially across all the loans. They're commercial loans, meaning we're not residential loans. And we're going to talk about why that's very advantageous in a minute. And within that, you can enjoy a higher risk-adjusted return with strong, predictable monthly cash flow that outpaces inflation. So before we go into how it works and what is it, the benefits of it, how it compares and contrasts to other investments, let's just talk about the durations and the projections, the returns, right? So brass tacks. What is it that you're getting into? If you choose to move forward, you have some options. We have short-term and long-term. Okay, before we get to the long-term, the short term is broken out into 90 days, half a year, or 1 year. 90 days, 180 days, or 365 days. Okay, that's a short term. Now, these are different than the long-term investments because these are what we call senior secured notes. What does that mean? It's actually really simple. It's the way for you to get fixed monthly income. It's predictable income. It's essentially giving the fund, our fund, a loan, an interest-only loan. So once you invest a principal amount, say $100,000, we will then give you a fixed interest rate on that yearly, and we'll pay it out monthly, right? And at the end, we return your principal amount. So it's essentially an interest-only loan. We call it a senior secured loan because it's actually in a preferred senior position to all the other investments, the longer-term investments, which means you're the first person paid. Now, in exchange for short-term investments, 90 days, like that's amazing. You could be in and out in 90 days. How could you possibly find that at a money market account? Even the high yield savings accounts are not doing that. Or half a year or 1 year. Half a year at 8.5% and 1 year at 10%. That's amazing again. How are we doing that? Now, in exchange for that, right? You can either invest in 90 days, 180 or 1 year, or roll them forward. But in exchange for that, you get a little lower return than the longer term investments, right? Yeah. 7%, 8.5%, and 10% for the 90-day, 180 and 1 year.
So this has been the shorter term. So again, there's kind of two segments here. One is like 1 year or less. And then we have basically the 3-year option, and they're both attractive for different reasons for different people. Again, if you need the money sooner, you can have it. Otherwise, it is tied up for longer. And actually, for the 1 year, you can reinvest those dividends, and it actually brings it closer to 11%. So if you actually don't need the cash flow, some people just reinvest, and then it kind of gets up a little bit higher as well. But this is very cool for less than a year. But I think the special one right now is the 3-year, and we're getting a lot of interest in that, because it has a higher return, and it's something that you can see why here in a little bit.
Yeah, we're seeing a lot of 6 month and 1 year. A lot of individuals either saying, look, I've got a ton of money in the bank. I don't trust banks right now. In fact, we're going to talk about Jerome Powell in a minute, who just got on in February saying, hey, look, we've just begun to see the trouble in the banking system caused by commercial real estate. We've just begun to see that. That was this year when the banking collapses we know were last year, right? So there's a lot of people like, well, I don't want to put it away maybe for 3 years, but I would love to get an allocation into something that produces a great return and a lower risk in 6 months or a year. But then if you're thinking about buying something or thinking about investing and becoming an equity investor, as Bronson's saying, and it's going to be a long-term investment to begin with, the longer-term investments, they provide a significant return, equity-like. In other words, the returns that are so large, it's almost as if you were investing into equity as an owner. And you can, as Bronson said, immediately start cash flowing from that instead of deferring it to the end or compounding monthly by reinvesting that. And that really shows up as this 3-year investment, right? That's instead of it being a fixed yearly interest-only loan, like the senior secured notes, it is a preferred return with the profit share, with the profit split. It's even structured a little bit like how owner sort of preferred returns and splits are done. But again, you're still investing in a debt portfolio. So it's what's generating your return is a secured position from loans in the same portfolio as the short-term investments. But why is this cool? This is cool because the short-term guys, those 90 days, 6 month, and 1 year, they're capped, right? But we're lending at 6 months mostly. Most of our loans are 6 months. So and there's 13, 14, 15% loans. Where does all that extra go? Well, that extra, we split the profits of that with the Class A and Class B share members, with the 3-year people, because they're in there for longer with us. That allows us to produce a much higher return for those willing to hang out for about 3 years. So below 250,000, we call that a Class B share. So 9% pref, 50% split. Above 250,000, we call that a Class A share. And that's a 10% preferred return with a 50% split. We originally projected 11% annualized for the Class B share and 12.5% annualized for the Class A share. But we have, since inception, been knocking that completely out of the park. We're actually currently at 13.6% for the Class B share annualized and 15.1% annualized. 15.1% annualized for a low position in the capital stack.
I want to break this down a little bit. So it can be a little confusing. When I first saw this, a little confused. The way you got short term, you got long term. There's a question that came up on the short term. If you invest for 90 days or 6 months, can you roll over to the next quarter or next 6 months? Yes, you can just keep rolling it over as long as it's available, whatever the current rate is. And we expect, right now the current rates to go forward. This particular one for 3 years. So everything we're looking at on the screen now is 3 years. The big difference between these two is if you're 100K, which is the minimum, up to 250, you get a 9% preferred return and then a 50% split. Now, this is not a split like we think of splits in multifamily. This is like the lending fees. A lot of these groups that are getting loans, they're paying 14, 15, 16% plus points on these loans. And you say, well, why would somebody do that? It's because we can close quickly. They can get a loan from a bank. It can take sometimes 3, 4, 5. Take a really long time right now. Lending is pretty challenging. And so this is actually a way that we can split some of those fees that we get with investors. And so when you look at the 9% preferred at the bottom there on the left, and then a 50% split, historically it's brought it to about 13.6%. I think the last month it's a little bit above these actually. Wasn't it a little higher than these? I think it was like 15.2 or 4 or something for the above 250, and then below 250 was 13.6, and it's paid monthly, which is really great.
Exactly. Yeah. Well done.
Cool. Just want to banter with you, Patrick, because you wanted
a
little witty banter
you
here.
Got it. So the difference is both of them can have accelerated growth potential. And how is that? People don't think of debt investments as typically growth investments. They think about income investments. And the reason why you could create a growth product out of a debt investment is because we will allow you to reinvest and compound monthly. And that's a significant attribute because as you'll see in just a minute, the monthly compounding returns ultimately extremely high. It grows very quickly, and it can make an extremely attractive growth product. And so both of them can allow for for significant growth. It is definitely outsized when it comes down to the Class A shares. Instead of fixed predictable monthly income that comes in exactly the same number for short periods of time, the longer term has a preferred return and a split. And so we have seen it wander around, a couple percent. And it's certainly not trending down. We're in a great time right now. It's awesome to be a debt investor. There's a lot of upside, and that's what you get to participate in the Class A and Class B shares.
Well, and Patrick, too, there's also a benefit when rates are higher, especially for the longer term 3 year. You get the pref plus the splits, which there could be a little bit if rates go down, which a lot of people think rates are going to go down. So this kind of keeps you, at least for the pref, being a little bit higher, and then hopefully some of those fees as well. But there's also a chance, and there's kind of a growing community that actually think that rates are actually going to stay, or maybe they go up. And so this is like actually something on the lending side. Lending, if it is difficult for longer and the Fed keeps doing what they're doing, it could actually lead to actually higher than what we had projected. So again, it could be lower, it could be higher, but I'm just saying there is potentially a little more upside on this too that may not be in the numbers, which is nice.
I think what's really exciting too, and we'll talk about it a little bit in a minute here, is that we're not really so worried about small fluctuations in interest rates because we're here because banks are troubled. Banks are troubled because commercial real estate is struggling. We're going to talk about that in a minute. And there's a huge demand for us, and that demand is only going to grow. And we're going to see some data to talk about why that is. And so it's an opportunistic fund to provide a product that people need right now because banks are pulling back and pencils down. And that is due to the distress in commercial real estate that will sustain for years from now, regardless of any short-term fluctuations in interest rate. So it's going to be really interesting to see how much higher. We're on a growth curve right now with this fund. Any short-term fluctuations in interest rate, we don't see making a material effect. So I just wanted to put this out there because compounding interest, ain't wonder of the world. He who understands it earns it. He who doesn't pays it. Albert Einstein, and that's what this reinvestment option is all about. This debt fund is opportunistic both for a cash flow and for a growth. And keep it in mind, you can switch back and forth as you would like. If you wanted to start out just cash flowing, or you want to start out, mostly people said, "Oh, I'm nearing retirement. I'm going to start out compounding monthly, and then that day that I retire, I want to be able to flip the switch and then just start cash flowing. But in the meantime, I want that principal to grow." And so if you're distributing at 12.5% is what we show here, that red line, your principal balance is not going to increase year to year. So this shows kind of that 5-year growth. But holy cow, what happens, right, when you get a Class A share, which we projected at 12.5%? That's this line right here. When you compound that monthly at 12.5%, that's above a 1.8 equity multiple. Your principal balance has gone above 1.8 equity multiple in 5 years. There are equity deals which are entirely back-ended, which you're hoping to get that on a sale. And this, you realize, compounding in principal every year. And so it's very cool how you can make returns like that happen. And that's assuming the 12.5% we projected for Class A share. If you actually take a look at the 15.1% that we had averaged and you then reinvest that, you're looking at a 22% annualized average return or a 16.2% IRR. That's over a 2 equity multiple. So a 2 equity multiple in a debt portfolio, right? We're in a debt portfolio well below all this volatility that we'll talk about here in the market, is a really amazing outsized return. And that's what makes this exciting.
So this could be good for someone with a retirement account that has just money sitting in there, that doesn't need the reinvest, doesn't need to see the cash, just wants it to be reinvested. Or, people use this for cash flow. We have people that are thinking, well, how much do I need to live on, right? If I have $500,000 saved, how much is that going to produce for me monthly, whatever? And there's a degree of predictability to this, which is really attractive for a lot of people.
And you can most certainly reinvest the 90-day, 180 in 1 year, and you can see that it turns the 10% to 10.5, right? Turns 180 into 8.8, 8.8%, 90 into 7.2. So it definitely does have an effect as well in the notes. So how do you know if it's right for you, right? And most individuals is what Bronson is saying. Some of them are looking for retirement cash flow. right? They're and real estate asset-backed debt products are great lowest way to achieve that. Get that steady cash flow through retirement, 7% to 12+% annually, and we distribute monthly. Portfolio growth, as we said, you can reinvestment those looking for a growth allocation, but their risk profile is pretty low. And they're a little bit, maybe a little worried about being an equity or a preferred equity investor right now, as they potentially should be. And they want that low risk growth potential. Inflation hedging. A lot of investors are coming to us saying, look, there's really nowhere I can put this where I feel like I'm not losing money with inflation. I not only want to just be at par with inflation, but I want to have a portfolio that grows with inflation. And I just want to make sure that it's in the right spot, that is more than treasuries and more than bonds, because that doesn't really get me there. Inflation hedging, capital preservation, that is the fundamental aspect behind debt. A low loan to value debt portfolio, which we'll talk about it in a minute, and simply diversify out of banks. I have investors that have been sitting with $500,000 to $5 million on the sidelines in banks and CDs, and they're just nervous about where it's at. They got too much money on one location. They want to put it somewhere. They want to put it to work. And a very common conversation is people just look, I see the trouble in the banking systems. It's real. Let's get it into hard. Let's get it into real assets. Let's get it into a senior secured position and diversify it out. So fund managers also invest with us, right? Portfolio managers, short-term liquidity. We have bridge investments. So if it cash flows into your pocket, it's an asset. If it cash flows out of your pocket, it's a liability. Robert Kiyosaki, everybody knows and love that guy. So this is where we typically jump in, answer any questions, or we could plow through to the end.
I think we should take a quick break real quick. I just put the link in there too. You can scan this with your phone. It takes you there, but I'll just share this real quick. There's can I share real quick, Patrick? I'm just going to share. Okay. Okay, let's go to screen. Hopefully this will work. All right. Can you guys see my screen? You see that? Okay, great. Okay, so this is the form you fill out. This is just kind of raising your hand, like, hey, I'm interested. I have some questions. This is just, we'll kind of be referring to this, but this is just kind of like the next step if you are interested. And then, of course, people have questions. They want to know, hey, what about this amount of time, or how do I queue this up and things like that. I just want to kind of point that out. If you do have any questions, go ahead and stick it in the chat, just so that we can kind of see if you have any questions at this point. Others will kind of plow along and keep going.
I will put the share back on. And if you're jumping in late, so this is the Bronson Equity Income Fund webinar. I'm tuning in with COVID from Hawaii here, and I appreciate your patience with my little bit lower energy. And we're going to go into the second half of this. We're going to talk about a lot of really cool stuff. We kind of talked about the actual returns, kind of framing up why this investment exists, why it's a good investment, who invests with us. And then we'll go into quite a bit more on the background of where its position is on the capital stack.
Somebody just asked if you have to be accredited, and the answer is yes. This is for accredited only, this specific investment, accredited only investors.
So what is the capital stack, and what are the risk and rewards of investing in the capital stack? Because you're a real estate investor if you're investing as an owner, as a common equity owner, or a preferred equity owner if you're investing in equity. This is equivalent to putting a down payment in a house, right? You're the equity. Those are that top two. But you're also a real estate investor if you're lending to the property, if you're holding a senior secured note. This is a mortgage. This is your home mortgage, okay? Now, if one day you decided, hey, I want to get a second position loan. Let's get your senior position. Well, actually, then I want to get a second position loan. Maybe I want to pull some money out, and I want to renovate my kitchen or something. So that would potentially be what we call in commercial a mezz debt, or a second second to the senior position, or a second loan on the home. So both of those would be secured loans, first and second position. Then you have your equity, right? And so both the equity investors and the debt holders are real estate investors. We call it the capital stack. Now, why is there such thing as a preferred equity versus common equity? That's because when you have very large equity pieces in commercial real estate, not so common in residential. You may have some investors that say, hey, I want the huge upside. And some say, look, I want a preferred position as an owner, but I want to fix my upside. But I just want a little bit safer equity. But this is still just being an owner, and you're still not the first person paid. And so we are not preferred equity. And it's very important for us to say that we are not investing as the kind of proverbial owner. We are investing in a senior secured position right now throughout our portfolio with some ability to do some other things, but we haven't had any need to. Now, it's important to understand the capital stack. Why? Because your payment priority is different and your risks are different. So your payment priority as a common equity is the lowest. It goes up as the preferred equity, as what we were just discussing. But your payment priority goes down. It gets higher as a mezz debt and then higher as a senior secured debt holder. So,
Patrick, can I say something real quick on this
Mhm.
too? So this is a question that came up. Somebody asked, well, is the money lent as debt or equity? Well, the money is lent as debt, right? So if you look at this bottom here, this is senior secured debt. This is first position. So we're not a second, we're not a supplement. There's no mezzanine. That's where people think debt funds are all the same. They just think, oh, I'm invested in a flipper fund or I'm invested in a debt fund. Some of those are incredibly risky. And if the value of the asset goes down slightly, there's any operational issues. This one at 50% loan to value, the property basically have to go down 50% in value for there to be a loss. So it's the safest position in the stack. So just as Patrick's saying this, the gray part at the bottom there, it is the first position. It's typically the only loan on a property. And the people are bringing 50% of the cash to the property. So this is not second. There's no Freddie Mac. There's nothing secondary. This is first position originate with a lender. So that's where it's kind of a mind shift to get around this, to think like, wait, we are the bank. We are providing the loan. The investors are providing money for this loan. So I just want to clarify that.
Yeah, so I want to say one more time that there is this possibility of that. I mean, we are not excluded from doing some second position investments, and that's just something I needed to make sure is very clear. But throughout the loan, we have 89 loans right now in the portfolio. We're averaging a little over a 15% interest rate across those loans. I think it was 58% average loan to value. So what Bronson's saying is absolutely true. 58% average loan to value.
So you're saying there currently are there any second position loans currently?
No.
Okay, but there's a ability to, if it made sense. But
within our documents, there is with an abundance of collateral, and especially when we're doing a loan workout, if a loan were to ever fail, we'll sometimes do a note structured as equity to make sure that we get the upside. Well, you have to have some ability to navigate
do it.
special
Yeah.
circumstances, and so that's why I'm just saying, you'll see in the documents that we are a fund here specifically for the purposes of doing recessionary debt, which is that low risk cash flow, low senior secured position. That's why we're hammering this home. But I also want to make sure that, and we will disclose a little bit later, that there is some ability to navigate within the lines in the best interests of our investors, right? So payment priority is lowest at the common equity. It's highest as the senior secured debt. Your potential return is highest in common equity. Your potential losses is also highest in common equity. So your potential returns lowest in commercial debt. Now, what does that mean? Well, that means also that your recession resilience is lowest in common equity. And this is what we're seeing today, where in common equity and preferred equity, it is potentially the most risky position to be in a recessionary time. And while we might not be in a recession macroeconomically, we are most certainly in real estate, driven by post-COVID economics, as well as rising interest rates, inflation, and all kinds of other things that we'll talk about here in a minute. But that the many investors right now are flocking to a more secure position. What's really interesting about that is that common equity has an outsized reduction in value through a downturn. So, for example, it's common right now throughout the United States in commercial real estate to see reductions in values of 10, 20, or 30%. So let's just take the middle ground. A $10 million loan with a 60% loan to value, that's a $6 million senior secured debt. Okay. That means they put up $4 million in initial common equity. Now, This is just the down payment to buy the property. And oftentimes they have more in CapEx, which we're not even going to address right now. Okay. But that 4 million in initial down payment, what happens if the property reduces by 15%? That's a 2.5 million reduction in common equity, reduced common equity. That is 37% loss for common equity. So a 15% reduction in value in this particular case. Most loans are even worse because they're 70% loan to value instead of 60% loan to value. But thinking halfway point on the reduction in valuations around the country and only 60% loan to value, you're losing about 37% on a 15% reduction. That's really important when the senior lender, and we're below 60% loan to value throughout the portfolio, and there's no loss for that lender. Now, it's important to know these are real estate investors, these debt people down here, right? So it's important to know that in a higher interest rate environment, payments are increased, valuations are reduced, profits are reduced for the equity owners, whether you're common equity or your preferred equity. Your payments go up, valuations go down in a high interest rate environment, right? But in a high interest rate environment, your interest payments go up, it increases the profit for your senior secured loans that were originating for the same asset, not more risky assets, for the same assets. And so it's important to keep this in mind that in this high interest rate environment, we can then still land in a safe position and get an outsized return. This is an opportunistic fund taking advantage of the upside from this downturn in commercial real estate through the advantageous interest rates. And also because the commercial banks are pulling back, so there's a high demand. So why private real estate debt funds? That's what we are. We're private credit, private debt fund. Relatively lower risk compared to equity investments. We've been driving that one home. You're still a real estate investor, just not an equity or owner. The returns, relatively higher returns to other fixed income products, right? This is higher than those bonds. This is higher than those treasuries. It's non-correlated. Low correlation to the rise and fall of stock market, bonds, oil and gas, or others. So real estate debt funds give you a further correlation from real estate equity owners and a further correlation from the market and oil and gas. And you diversify. In a pool of loans, you can diversify across attractive markets. And really, it's that stability that people are looking for in an uncertain time. And the debt funds do provide that consistent return with some stability. And we've demonstrated that through the returns that we've provided. And right now, banks are under pressure. This is important play because you always want to look at your competition. You're looking at the stability of your returns. And with regional banks in a liquidity crunch, that means commercial real estate loans and bridge loans that they lent on, those are not paying off, unfortunately. And since interest rates increase, the bonds that they bought are devalued. So they have a liquidity crunch. They're taking losses. Performing real estate properties that they used to lend on, they're pulling back on. So they're not lending as much on performing quality income producing assets. It gives us a lot of opportunity. Meanwhile, debt's maturing. So new loans are not getting offered and renewing loans after the debt matured. In fact, there's $1.5 trillion in commercial real estate debt maturing by 2025. And the banks are not servicing that right now, just like coming out of the global financial crisis in 2009 in turn, private debt, private credit helped fill the need for debt. We're doing that again right now with higher interest rates. And so there's a lot of financially distressed owners out of COVID, and it provides higher returns to investors. And higher interest rate environment provides lenders offers outsized returns to debt investors at a lower risk. So it's opportunistic timing in the market. That's really the point there.
Hey, Patrick, I know I want to make sure we have time for some questions here before we get going. How are we doing on how many more slides do we have?
I'll move pretty quick. Yeah. Okay, cool. So what makes this different? We're not doing single family. Single family is a completely overpopulated market. they're lending way too high. Not are they doing very, very high 80, 90% loan to values, but they're doing after repaired values or construction after completed values, meaning that our loans, which are loan to current value, which gets us that 58% loan to current value of the asset, they're lending 80, 90% and hoping that with the money that the operator then creates a bridge, right? By improving the asset. We're not lending that way. We're doing it in friendly areas. We're also not preferred equity. It's really important. Preferred equity locks you in with the owners. You're an actual owner and equity investor. They don't give immediate cash flow. It's not in a secured position, and they don't offer reinvesting for compounding. Why are we able to do 13% interest rates? Well, we're still lending on the properties that were 68% interest rate. We're still lending to those same properties that were 6 to 8% interest rates 4 or 5 years ago. But as a combination of, sure, interest rate hikes, but mostly banks' liquidity crunch, our reputation and trust, and our ability to remove rapidly, our loan origination companies, PEM Rapid Lending, we're able to command and get repeat business at much higher interest rates. Is this going to continue regardless of what interest rates do? Absolutely, because this Titanic is beginning to sink here, and we're not sure in commercial real estate how far it's going to go. 64 billion in commercial real estate distressed debt, and 1.5 trillion. And then Jerome Powell just got on in February, what was this, February 6th, saying that we have yet to see the impact of commercial real estate on the banking system, which means we have a great opportunity to step in and fulfill that need. What kind of loans do we originate? We originate loan to current value, but mostly entirely short-term bridge loans, acquisitions, rehab, other short-term financing. We have yet to acquire mortgages, but that's certainly part of the ability for us to purchase existing loans. We haven't done any rescue capital, and we do some debt allocations in diversified portfolios to make sure we're meeting our concentration requirements. We're in some of the more, we're diversified across asset classes, and we're in some of the more favorable markets. Here's an example of a bridge loan we did. Excellent tenants, $2 million loan, 50% loan to value, 13% interest rate, 2% origination points with a 1% extension. That's a 6-month plus 6-month term in Missouri. First lien position. This was performing cash flowing asset, was bought at a 10.2 cap. It's an amazing loan.
Pat, there's a couple questions coming out about frequency of distributions, quarterly or monthly. These are they're all monthly distributions. And so the question if they're monthly or compounding, the answer is depends. If you want monthly payments, you get monthly payments. And if you want compounding, then you can have those reinvested. So it depends how you want to do it. And that's what the slide we talked about earlier. So you can have it monthly and have a payout every month. And then, or, you can compound it. And then a question about the 1099 or K1, the 1 year or less is 1099. If it's over, if it's the 3 year, then it's a K1. So it depends on what type of investment you're doing.
Right. Yep. And so I don't know if you want me to go through some of those loan examples, but we can just go into questions from here, Bronson.
Sure. Yeah, we can go to questions. People have questions. So this is a good, like what you're seeing in front of you here on the right side. You've got the light blue there where it talks about the 3 year. You've got the B shares, which are, the higher amount where you get it's the lower amount. B shares are 9 pref plus a 50% profit. And then the A shares are 10 pref plus a 60% profit. And the profit is, again, it's not from equity of like what's being gained in the deal. It's actually from the lender fees. So that's where that's coming from. And then the left side is all 90 days to 1 year. So that's kind of the shorter term fixed rate stuff. And actually it says on the bottom of the tax document, it says 1099 is on the left there and on the right is the K1. So, but yeah, anybody else have any other questions? I know for me, it took me a little while to kind of understand this, kind of how it looks. Ed is asking, can you invest through a self-directed IRA? Yes, you can. You just have to make sure that they allow for, investments like these. If you have sometimes a Charles Schwab or something, they, are more traditional. Morgan Stanley, they may not allow for it, but certain ones will. So you have to kind of check with them. If not, there are some that I recommend. We recommend it usually takes about a week or two to kind of transfer funds over and get everything set up. But there are self-directed ones that you leave it in the retirement wrapper and you just kind of roll it over to a new account that allows you to invest in these type of investments. Well, the one I recommend, Patrick, I don't know what you recommend as well. There's a few. There's one called UDirect IRA, which I like. UDirect IRA, that's a good one. There's also, I think the QRP is another one, but they're a little more expensive, but they're kind of like they do a lot of other things, or the EQRP.
Yeah, I have the Karen from UDirect on my webinar tomorrow. She's great. Rocket Dollar has done great. They have a very close. They do a lot of one-on-one equity trusts. Some of those bigger ones that are out there. It's a little. You're kind of lost in the shuffle sometimes.
I've had a couple of big issues with Rocket Dollar. So I've had a couple referred over there that people have had a challenge with customer service, but maybe somebody else has had a good experience with it. Yeah.
Okay.
Yeah. Somebody's asking, does junior on the 3-year, what does it mean, junior and senior? So this over here under priority, about halfway down. The senior is just, can you talk about that, Patrick? It's just paid out at a flat rate, and the junior just means it's paid out as a pref, right? So just it's kind of the way it's worded is a little different. It's just junior to what gets paid out first is the shorter term stuff, correct?
Yeah. So essentially, all the money goes into a loan pool, and then when we go to make payments out of it, we first fill the buckets of the senior secured notes to their fixed rates, 7%, 8.5%, and then 10%, right? And then when those are full, and keep in mind, there's a bunch of upside that they're not getting, right? In exchange for that, they're getting that fixed rate. But then what's left over then goes over to the Class A and Class B shares, and they're filled up essentially pari passu, simultaneous to each other. And then when they're filled up, we just keep filling it up, right? Because then they get to share in the upside of what didn't go to the Class A and Class B. Happy to that. I hope that helps. Let me know if that answered the question.
Yeah, I think it makes sense to me. Any other questions on this? Again, if you are interested in joining, we put in the chat here. This is not committing you to, hey, you have to just kind of raising your hand saying, hey, I'm interested. I want more information. You go to that site, it will send you more information, and then we can follow up. Or if you have any specific questions, you can feel free. We can get on a call, or you can shoot me an email, and I'll just put my email in. I think you guys have my email, but I'll put it in here. And again, I like this for a lot of reasons because again, it's a safer investment that really is really probably the most secure real estate position is to be in a debt position, and especially first position like these notes are, and also the monthly cash flow and the way and just the options. You have the options. If you don't need the monthly cash flow, you can compound it. If you want to do shorter term, you can do it. If you want to do long term, you can do it. And I think that the rates that we're being offered right now in this fund are very attractive. And we don't know. It may not be around in 2 years, right? It may be that the Fed does lower rates and all of a sudden there's an offering, but instead of a 9 or 10 pref, it's a 7 or an 8 pref, right? It's just a different, maybe even lower. So we're just not quite sure what it will look like. The question from Darren here, a couple questions coming in here. Is this 50 or 60% profit share rectified and paid out at the end of 3 years? It's paid out on a monthly basis, and it's paid out a month late. There's a reason they have to kind of, so the pref is paid out, and then a month later, is that correct, Patrick? It comes out for the payments.
Yeah, so the preferred return we pay out on a month, and then there's a delay for us to do the books to tabulate the split above that. But yeah, you realize the income immediately as fast as we can get everything in to do the splits. We do that for the Class A and Class B shares.
Yeah, and then question from TS here is, does each tranche require 100K after this? No, it's basically 100K is the minimum. So if you want to do 105K, or you have, well, people that have 112K and even it can be a combination of accounts. So sometimes people will have like 50K in one account and 50K in another account. You can get to 100 by doing that. Or people will do it with the 250, which is the big tier that gives you the higher amount. They'll be like, oh, I've got 100K in this account and I'm bringing 150K cash, or one's the retirement, and then we can do that. So as long as it adds up to those total tiers, but the minimum is 100K. However you get there, you can go 101K. You can go, I think it's to the nearest 1,000 generally. Is that kind of how we do it? Or how does it, I guess it depends.
Yeah, we've had some retirement accounts give us some pretty funky numbers. I think we're pretty creative with just making it work with fractional units is what they call it, right?
And I will say something too, they just to temper expectations. Sometimes when funds come in, they can be deployed very quickly, but we typically it takes 2 to 5 or 6 weeks before we can actually deploy it, and then it takes about a month after that before people start receiving cash flow. It's not like you immediately send money over, and then it's just like 30 days later. It's like, but once it starts paying, it's a consistent time each month. It's very consistent. It's just in the beginning. Does it take a week to deploy? Does it take more like 5 weeks? So it can take a little time to deploy, and then it's about 30 days after that the payments start. Let's see if we have any other. Oh, here it is. How long is the fund projected to be open? Patrick, what do you think?
Oh, it's an evergreen fund. Yeah, so we do not have a timeline for closing it down. My partner Lance ran a debt fund for like 10 years last time. So before they wound that down, we'll probably continue to do something similar. It's right now, it always made sense to do it. It just happens to be an incredibly opportunistic time. I don't see from my where we're seeing the banking system pull back. We're not seeing any end. In fact, the number of leads that have come through in the last couple of months are more than we got all of last year. So we're seeing a whole lot more demand, and which allows us to drive our rates higher. And we're about to originate a loan for 16%, right? And we've been
Love it.
trending at 13. So I don't, and as you saw Jerome Powell just this year on February 6th say that we're about to see more of this impact. I see this at least being very exciting for the next 3 to 5 years. And it may start to lower down over, subsequent to that.
Yeah, absolutely. Somebody's asking about the replay of the webinar. It will be sent out. So I've just, so you'll get that probably, if not tonight, you'll get it by the morning. And yeah, so we'll definitely have that. And again, I'm available if anyone wants to chat. And again, it's interesting with this. We don't have like a hard deadline. Usually we'll have stuff where it's like we're open this fund and it's a very short period of time, limited space. This one, it's going to be open for a while. Obviously, the sooner people put money in, they get deployed, and there's opportunity there. But again, you just think of the alternative. What's the alternative? The alternative is you sit in the stocks, you sit in cash, you sit in something, and you just wait, and you're not compounding or getting those cash flows that you want to get. And you just think, I was doing the math with somebody who was getting, saying I'm trying to replace this amount of income, and it's like, okay, with 500K at 15%, that's a pretty good monthly payout, right? That's a pretty good amount people are going to get. And so again, it just depends on really what your needs and your desires are for that. So if we don't have any more questions, we can go ahead and wrap this up. Please feel free to reach out to me. I can also, there's really specific questions, and we've been doing this for a few months now. We've been really enjoying this specific. The lender's been doing this 20 years. So Lance, these guys have been doing it for 20 years, and really excited about what we're creating with this. And again, this is going to be ongoing. So we're really excited to see what's going to be created. Patrick, do you have anything else you want to share before we wrap up, or anybody else have anything they want to add in the chat before we wrap here?
What dollar amount of properties do you expect to finance monthly on average? I think we have the benefit on our fund of being able to be, very patient and pick and choose. Sometimes we'll originate, a loan a week, sometimes, one a month. And, we have a lot of lead flow, and we have patience ability we're small balance commercial. So we've done things as low as 400K, where we've done one, 2 million plus. Keep in mind that was like a 41% loan to value. So very low risk. We don't necessarily have any requirements. When Bronze is saying the funds, just rolling forward, and it takes us sometimes to deploy capital, that's because we're patient, and we put the capital once it comes in and everything's complete into a subscription account, and we don't draw down the rest of the investors' returns until it's deployed. That gives us the ability to not have to deploy immediately into loans that we would rather not. And it gives us the ability to have the cash on hand to deploy to loans immediately that we would like to. And so sometimes like Bronson was saying, it's been 2 weeks. Sometimes it's been 4, right? I think one time it was 4. But if you think about the return profile, I mean, we're placing it into investments that are returning above 11, 12 currently right now in Class A is like 15%. If you invest into an equity deal, sometimes you invest in those and it's 1, 2, 3, 4, and 5 months before they close, right? And you don't realize those returns until the back end. And those are returns that are realized immediately, annualized returns immediately. So, in the broad scheme of things, it's a great product.
Awesome. Cool, guys. Well, hey, appreciate everybody being here. If you do have more questions, again, shoot me an email. I put it in the chat. You guys can reach out to me. We can get on the phone, and I would love to connect with you. I know some of you guys have been watching this for a while, and we're very excited about it. So look forward. Actually, Cheryl, do you have a question? It looks like there's a hand up there. I'm not sure if that's just like a hello, but it looks like Cheryl's got a hand up there. I'm not sure. So anyway, Cheryl, feel free to reach out to me if you'd like, and appreciate everybody. Thank you, Patrick. Again, this recording will go out as soon as it's available, and we'll look forward to seeing you guys. We do have an event coming up, an educational event. I'm really excited about this one, guys. This is June 11th. I've got 4 guests. 2 people are super hot on Bitcoin and why it's the best thing ever, and 2 people are super hot on gold and precious metals. So they're going to have a knockdown, drag out fight on which one is better to preserve wealth. So I'm excited for that. We'll have some more information. Stay tuned for that. June 11th, 4 p.m. Pacific.
That sounds fascinating. Both my gold and Bitcoin are doing well right now. I'm
Yes, I
gonna
love
have
it.
to tune into that one.
And your hairdo is doing really well, just like mine, man. Just to really appreciate it.
Well, it's not keeping the COVID at bay.
Yeah,
So,
yeah, that's right. Matter of fact, you'll get an email on it. It's 4 p.m. on June 11th. You'll get the emails. We haven't created them yet, so you'll get them when it's available. I just wanted to put the bug in here. It's going to be fun. So, thanks everybody. Look forward to catching you guys again soon. Thanks for being here. Appreciate it.
alrighty.